Hi, this is Daniela Cambone, and welcome back to StansberryInvestor.com. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,000%, Digital Turbine before it shot up 789%, and Overstock before it shot up over 1,000%. This power gauge comes from the legendary Mark Chaikin. And right now you can get a free in-depth look at how his power gauge system works. A way to type in any of the 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugetrial.com for your free look. Again, that's powergaugetrial.com for your free look. All right, let's get to our segment today. Hi, I'm Daniela Cambone, and welcome back to Stansberry Research. Our Outlook 2022 continues with my guest today, George Gammon of the Rebel Capitalist. George, always good to be with you. Welcome back to the show.
Hey, it's great to be back. Thank you for having me, Daniela.
Yeah, first and foremost, I know you just wrapped your Rebel Capitalist show. Lynette Zine was there, Ron Paul was there, Robert Kiyosaki was there. I want to get, some of the key takeaways from that conference that really stood out for you, since you had like these great minds all in one room.
Yeah, we had Joseph Wang there as well. I like to mention him because he ran the New York Fed's trading desk. So he was actually the person that was in charge of quantitative easing. So when you see that the Fed is buying 120 billion worth of bonds every single month, he was the one that was actually executing the trades. So if there's anyone that knows the inside of as far as how the plumbing works with the financial system, it would definitely be Joseph. And Lynn Alden was there as well. We had 12 just fantastic, amazing speakers. And Ron Paul closed out the event. And I was kind of playing the MC. And it's a moment that I'll never, ever forget for the rest of my life. I was introing Dr. Paul to the stage. And he was walking up. He hadn't even made it to the stage yet. And all 700 people that were in attendance were standing on their feet, not just clapping, but literally cheering for Ron Paul. And I mean, it just gave you goosebumps, and it was just such an amazing experience. But the entire event was absolutely incredible, but I'm a little tired.
I can imagine. I can imagine, and I'm sure you'll appreciate recuperating post putting together a huge conference like that. But you mentioned the Fed. Let's go there. Let's start there first, because it's a new year. We have a new policy apparently coming from the Fed here, where they will, really hunker down on the taper here. Do you buy the narrative?
Well, it's not just a taper. Let's go back a couple weeks, and this is something that we were really talking about at Rebel Capitalist Live, is we got the Fed minutes when the market just fell out of bed, because we were expecting the tapering, or at least them talking about tapering, down to zero of QE and then raising interest rates. I believe they were talking about raising 3 times in 2022. But what the market didn't expect is for them to talk about quantitative tightening, which is when they're actually reducing the amount or the size of their balance sheet. They're selling the treasuries and mortgage-backed securities back into the market. Now, this is huge. This is really, really a big deal. And one of the main things we were talking about with Joseph and many other of the insiders, if you will, at my event, is what does that actually mean for markets such as repo? And I'm sure most of your viewers will remember back to September of 2019 when we had the repo spike where it went up to 10%. The reason that's such a huge deal is because it brings up all other interest rates throughout the economy, and it even brought up Fed funds. If you remember back to that time, Fed funds was the range between 2% and 2.25%, and that brought Fed funds up 5 basis points outside of the range. So what happened is the Fed completely lost control over the short end of the curve. So not only do you have interest rates going up significantly if that repo problem would not have been solved, and that means mortgage rates going up, auto loans going up, credit card loans. That means corporate debt. That means even dollar funding in the Eurodollar market outside of the United States. I mean, this could have collapsed the entire global economy. But in addition to that, you have a complete loss of confidence that the Fed has control of anything, because if they can't control the short end of the curve, what can they actually control? So that was back 2019 September. But now let's think about what's going to happen, or what they're saying is going to happen in 2022. So they're talking about increasing interest rates. All right, well, let's think about that for a moment. Because if you've got, let's say, $1 billion worth of treasuries that you can use as collateral in the repo market, those are bonds. So if the interest rates go up, the price of those bonds goes down. Well, that means you have less collateral to offer a counterparty in repo. So you might have the same amount of bonds, but they're not worth as much. So before, let's just make things easy, say that you would have had to pledge, let's say, 1 treasury to get the liquidity you need. Well, now you need 2. So that means that there's a collateral shortage. Well, let's move on to quantitative tightening. What does that do? That reduces the amount of bank reserves that are on the balance sheets for all of these banks that lend into repo. So that reduces their balance sheet capacity. That's the cash crunch that we heard everyone talking about during the last repo spike. So there's 2 main schools of thought. I like to look at it from a standpoint of Joseph Wang, who we discussed earlier. And everyone, I'm sure all of your viewers know a good friend of mine by the name of Jeff Snyder. He is probably the foremost expert in the repo market that I know. So Joseph believes that 2019 was a result of a lack of cash, i.e. bank reserves denominated in dollars. And Jeff believes that the repo spike was a result of a lack of collateral. But if you think through what the Fed is doing in 2022, they're going to be reducing the amount of collateral by increasing interest rates, and they're going to be reducing the amount of cash potentially by doing quantitative tightening. So my point here is that if we take the Fed at their word, I think they don't even understand what they're doing. They're like a bull in a china shop. But they're going to be increasing the probability of us having another dramatic repo spike going into 2022 that could bring the whole house of cards crashing down.
Wow, that is a dire situation that you just painted, George. But you don't think that they're aware of that scenario? They want to avoid that at all costs?
Yeah, I don't think they're really thinking it through. It's just one of these. I think they see what's right in front of them, and they know that inflation is at 6.8%. My research assistant Josh just told me the headline number increased today to 7%. I haven't actually seen that, but that's a big deal. So you got to look at how negative real rates actually are. I mean, if we've got the CPI print headline at 7%, and
people don't even buy that number. People,
I know.
People don't even buy that number.
I know.
It's way higher.
Yeah, but let's just assume that it's true for a moment.
Okay.
And then let's say the 10-year is trading at, I think it's around 1.7, 1.8, but let's just assume it's 1.5%. You've got a negative a tremendous negative real yield. I mean, to the tune of about, let's say, if CPI is at 10%, so you've got a negative real yield of approximately 8.5%. So let's think about that. How is the Fed going to tame inflation? Well, if we go back to the last time they did this, when Volcker spiked rates, they tried to increase interest rates throughout the 1970s, and it didn't work because they didn't take rates high enough, meaning they didn't get high enough above the rate of inflation, but they had to have positive real rates to smash inflation. How can we expect to smash inflation when real rates are still negative? Meaning that let's say CPI or consumer prices are really going up by 10% per year, and you increase the interest rates to 3%. Okay, we're still at negative 7%. So how is that supposed to tame inflation? Now, it might bring down asset prices, that's for sure. But I don't think that it's going to impact the amount of money that you're paying for groceries or your kids' college tuition. Those are two separate things that we need to compartmentalize, right? But my point is the Fed is really backed up into a corner where they've got to try to do something about inflation. But what can they do if they try to beat inflation? Well, they're risking repo if they're even cognizant of that. But the one thing I know they're cognizant of is that raise in interest rates or quantitative tightening could definitely bring down asset prices, i.e. the stock market and the housing market. And if the housing market comes down, if the stock market comes down, then that's going to bring down the real economy as well. Because now the Fed has created this environment where the total economy, our real economy, is completely built around the stock market and around housing prices for the majority of Americans' purchasing power.
Exactly. And so much good stuff there, George, and so well said. And I was going to say, it's a real conundrum for the Fed. I mean, Powell has come out and said, inflation is almost dangerous now.
Right.
But because they're focusing so much on inflation and they have to fight the inflation beast, that in that process, they may bring down the entire house.
Yeah. And what's really fascinating is to think through the lens, or think through it, looking at it as if you're a politician. So there's a lot of unknowns. I always say there are only probabilities, there are no certainties. But one thing we can say with probably 99% certainty, the politician's number one priority is getting reelected. And another thing I think we can say with probably we'll call it 5% certainty, is that the political administration has a lot of influence over the Fed. The Fed isn't really this independent entity that we'd like to think that it is. So if you're the Biden administration, let's say, the fastest way you can not get reelected is to have consumer price inflation. We've seen that throughout American history. There's almost zero chance that you get reelected if we see a CPI print at 7%, 8%, 9%, and actually going up. So think about that. If you're the administration, you've got to call Jerome Powell on the phone and say, hey, you've got to do something about inflation ASAP, or I'm not going to get reelected. And then Jerome Powell says, okay, I'll do that. But just keep in mind, if we do quantitative tightening, if we do the things that are necessary to tame inflation, it's going to tank the stock market. And how are you going to get reelected then if the whole economy is crumbling around you? So both the Fed and the politicians are in a very, very difficult predicament.
Well, and to that point, I was going to say, they also don't want to crush stock market, but you think they'd rather bring that lower inflation.
Well, I don't know what they're going. Yeah, I don't know what they're going to choose. It's kind of, you're damned if you do, damned if you don't. I think that they'll try to have this soft landing, if you will, where they're just this balancing act, right?
Yeah.
Well, maybe we can just bring interest rates up enough to where we're not going to collapse the market, where we have maybe a slow grind down. So maybe we have the stock market go down by 20%, which I don't think the Fed would actually mind, as long as that happened over a period of, let's say, a year or two.
Right.
What the Fed really doesn't want, or no one really wants, politically or the Fed, is for the stock market to go down by 20% in 2 weeks. That's when the credit markets potentially freeze up. That's when we have an event like you saw back in 2020 of March, and that's what could really bring about the next economic collapse. So they're trying to avoid that. So I think in their minds, if they can just fine tune the interest rates, do a little bit of quantitative tightening, maybe until the market kind of spasms like they did back in 2018. And then, that can bring down inflation gradually, or at least get the CPI print going from 7% down to 6%, maybe down to 5.5. At least that might be politically palatable, because the administration can come out and say, oh, see what we're doing? We're really combating inflation. It's trending down, therefore vote for me. And although the stock market is down, it's not down enough to where most people are concerned with it. And I think this is kind of the best case scenario for them.
So bring it home for us then, George. Confronted with this reality and these two paths that the Fed might have to diverge on here, what is the best way as an investor to protect oneself given the current scenario?
Well, for the average investor, it's very difficult. I mean, for a sophisticated investor, I think you got to go long volatility. So there's some guys out there like Mike Green and a good buddy of mine, Chris Cole, who was at our event as well. And they run funds that do this. Now, if you are really sophisticated, with options, you can do this in your own portfolio. But I think that would be my number one priority if I had that skill set. Now, if you're just a normal investor, I mean, I think you obviously have to own gold here. You got to own the gold miners. I'm not saying go all in by any means, but that's the one thing that I think is pretty darn cheap right now when you look at profit they're making, and that gold is really something that's unloved. And that's when I really like to look at an asset class, is when no one's really talking about it, and anyone that is talking about it has left it for dead. Oh, it's all about crypto now. It's all about crypto.
Well,
And I'm a big fan of Bitcoin. I think everyone should own Bitcoin, not necessarily because the price going up, but more so because it gives you purchasing power that's outside of the banking system. But everyone believes that, it's gone this direction, and they've kind of forgot about gold. Oh yeah, that's antiquated. That's a barbarous relic. And that's when I like to take a second look at it. That's when I get interested, and that's when I put it on a watch list. And now another thing that I think is fascinating moving into 2022, and I don't know if I'd have an investment theme on this, but I'm sure a lot of your viewers could kind of think through. And this is the fact that this, I always call it a scariant on my YouTube videos, because I'm always paranoid that they're going to take down the video or take down my channel, which they've done before. But most people know what I'm talking about here. This recent variant, we'll just call it, leave it at that. And I think this could be very mild. Hopefully that's what the data is showing. And I think that politically, especially in the United States at a federal level, that this is also something that is unpalatable. And I think this is a platform. If you're the Biden administration, as an example, and you're continuing to try to get reelected on a platform of taking draconian action against, with mandates, as an example, I don't think that's going to win you any votes. And I think they realize this. I think you can see that in Biden's polling numbers. And so they're trying to figure out a way to back out of that. But how do they do that while saving face with their constituents? I think it's because they do so by pointing out that this recent variant is far more mild. Therefore, we can pull back on the restrictions, we can pull back on the mandates, and then that gives them some kind of political cover. So what does that mean? Well, I just saw that the Mandarin Oriental in New York City sold for $98 million. That is cheap. Now, I'm the last person that you could consider a fan of New York City. I absolutely hate what New York City is doing right now. I would not go there if you paid me. I always say this in my videos, that I'm not anti-vaccine by any stretch, but I am definitely anti-vaccine mandate. But my point is that New York, it's down. I mean, there are blood in the streets right now, if you want to look at it that way. And I think that there is a possibility, and maybe it's 50-50, I don't know, that moving into the summer, that the pandemic will be in the rearview mirror. And if it is, then you could get some cheap assets, maybe cheap real estate, commercial, in some of these areas that have just gone off the plot as far as their crazy, insane approach to dealing with COVID, such as the Mandarin Oriental. I know their revenues, their gross revenue in 2018-19, if my memory serves me right, was right around 115 million, and their revenue in 2020 went down to 15 million. 15. And so this, I think he's the richest person in Asia, went in and bought a controlling stake. I think it was an 80% stake for $98 million. And so
yeah,
I'm not saying run in and buy real estate in New York City. I'm saying just use that concept to maybe look at your own portfolio, or maybe find opportunities that would occur as a result of the pandemic being in the rearview mirror going into the summer.
Well, New York City is my current home, so I hope you'll still come visit me one day, George. But
I don't think I can. I don't think I can, because I don't have the vaccine, so I don't think they'd let me in anywhere. So maybe we can just go to walk around Central Park and talk macro.
98 million is cheap, considering it's in prime Columbus Circle location. So it is cheap, but I was going to say, does not match other real estate. If you're looking to buy a home in New York, prices, have come down somewhat, but still extremely expensive. So
yeah, Yeah, I would not suggest residential real estate. But my point there is you got to find opportunity in things that are unloved. And I think the gold miners and the gold definitely want. Silver, another thing. I think uranium could be interesting. I know it's run a lot, but if you look at a 2-year chart, it really looks like it's run. But if you look like it at a 20-year chart, we've got miles to go. And I know that the European Union just came out and announced that they were including uranium into what they consider quote unquote green energy.
Mm-hmm.
So uranium's got a lot of tailwind. And I think we could see kind of prices move down in 2022 with commodities. They could have faced some headwinds because of what the Fed's doing with interest rates. But long term, I definitely think that we're in a commodity super cycle.
On that point, what about copper? Do you like copper? Copper, is it the new oil for you?
I don't know if copper would be new oil. I think oil's the new oil because I think that there's so much or so little capital investment going into new supply. Same thing with coal. That's something that's not on most people's radar. And I think coal could be the next tobacco. So what I mean by, and again, I'm not talking about the short-term prices, guys. I have no idea where it's going in 6 months. The prices could come down. I'm just talking about the next 10 years. And if you go back to, I believe it's the late 1960s, and I think it was 1969. If you go back that far, the best performing stock in the entire stock market when you reinvest dividends is Altria. And then if you go back to the mid 1990s, the best performing sector is tobacco. So, and that's something that's completely off everyone's radar. For those of you who were alive in the 1990s or adults, you remember that no one would touch tobacco with a 10-foot pole. They thought all those companies were going out of business, yet they were the best performing industry, let's say, since the mid 90s in the overall stock market. So I think coal is could be the same thing. They're paying huge dividends. And it's something that demand, I don't know that it's going to decrease that much when you look at the global demand. And it's persona non grata. No one's investing in it. And that could be the opportunity.
Just 2 quick points before I let you go. Getting back to Bitcoin, there's been, a lot of exuberance in this market, as you know. And I've had other experts coming on saying that it's having a .com moment. It's going to enter a long winter phase here. Are you not concerned that it's trading in tandem with the stock market? And if you see a stock market correction, what would that mean for Bitcoin prices?
I think it goes down. Same thing for gold. Because now let's be clear here. We're talking about a March 2020 event. If the stock market goes down by 20% over the next 2 years, I don't know. I think that Bitcoin is more of a risk-on asset. I don't know how gold would really behave in that environment. But if we get a 20% down in 2 weeks or 20% down in a month, I think gold and Bitcoin go down significantly, which could be a buying opportunity. Why is that? Because these hedge fund managers and these giant pools of capital, they're going to sell anything on their balance sheet that's liquid. And if they can't sell their corporate debt, if they can't sell their, you name the asset class, they're going to sell their gold, they're going to sell their Bitcoin, because that's the only thing they have on their balance sheet where they can get a bid and they can get the liquidity that they need. So that's why when you go back to like 2008, when you look at Lehman Brothers and what happened with Bear Stearns, you see gold was extremely volatile. And it really went down significantly during some of those timeframes. Also went down during March of 2020. And again, it's doing that because everyone's just selling it, not because they want to, but because they have to. And I think you could see Bitcoin fall into that category as well.
A point on cash from you. So in your portfolio, right? What are your views on cash? How much do you like holding here?
It's very difficult because the Fed and the government really has put us into this environment where we have such high rates of inflation, but we're also in the everything bubble. So, you want to have cash on the sidelines to take advantage of asset prices going down, while at the same time, you've got a negative carry relative to your daily expenses. So that's something that everyone just needs to decide on their own what they think the probability of us having a market, let's just say, crash, or a housing market crash, although that takes a long period of time. But let's just say a stock market crash in 2-3 weeks, maybe a black swan event would be a better way to describe it. Therefore, that cash on the sidelines, you want that to take advantage of those super low prices. I remember back in March of 2020, I was buying uranium, I was buying gold miners, I was buying a lot of shares, and I was able to do that as a result of having a lot of dry powder. And although I had a negative carry on that dry powder, you still wanted that optionality. And I think it's different for everybody based on what their individual objectives are. But I definitely see a reason to hold cash right now, based on what the Fed is going to be doing, or say that they're going to be doing into 2022 with raising rates and potentially doing quantitative tightening, which could really drop asset prices.
A point on this I'd love to bring up with you before I let you go. I had David Morgan on the show. We spoke about the possibility of not a bailout, but a bail-in happening should a next financial crisis hit. Do you see that as a possibility, a bail-in where the bank would seize control or part of your money? Could that happen?
Absolutely, it could happen. But again, it's a matter of probabilities. I think the probability is very low. Because look at the Fed's balance sheet, it's almost at $9 trillion. So what that means is the majority of the liabilities on the Fed's balance sheet are assets of the commercial banking system. So the commercial banking system, and just to give you some context, prior to the GFC, the amount of reserves in the system, the commercial banks, was around $40 billion, 40 with a B. The last time I checked, and this was when the balance sheet was back at like 8 trillion, that number was maybe $4 trillion. So the banks are far more liquid now than they were back during the GFC. I'm not saying I'm bullish on the banks by any stretch, but I think the probability of the central planners needing to do that type of bail-in is extremely low, although it's definitely not zero.
Very well said. George Gammon, I appreciate your thoughts. Come back anytime.
Thanks for having me.
And thank you so much for watching Stansberry Research. Be sure to stay tuned. In the meantime, don't forget to sign up for premier content you can't get anywhere else at danielacamboni.com. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.